Wonderful. Good evening. Good afternoon, ladies and gentlemen. Nice to meet you again. It's Wednesday afternoon. It's Marcus time. And I really appreciate it that you spend your lifetime with me this afternoon. And today we are going to talk what is currency correlation. It's a great topic, including the following topics. What is this special currency correlation? And how we can use it by correlations to change when we trade forex, and we want to switch between the chart and the slides to show you how you can use it in real, because this is one of the most important topics as a forex trader, as a real experienced forex trader. So I hope you can make sure that you stay until the end of this webinar, or I hope you stay until the end of this YouTube video later, because when I want to show you about the how currency correlation can help traders manage their portfolios more appropriately. And this is what we want to talk about today. So my name is Markus Gabel. I'm a trader, coach, speaker, mentor in German and in English. Please be patient and mercy with me, because English is not my preferred language. So I'm a German guy, so my English is German as well. But I hope you will understand what I try to explain to you. If not, please type it in the chat box. It's open. If you want to make kind of a conversation, because I'm not the entertainer. I'm not the important person here in this webinar. You are the most important. You are a VIP person here, because I want to teach you. I want to share my experience with you. But please be aware that it doesn't replace a proper education. For if you want to learn trading, then you should take a teacher and a mentor who guides you to your own personal trading success. But be aware, it costs money and time, of course. But most of the times, finally, it costs less money and less time than you will try it by yourself, by try and error in the market. Believe me, I made this kind of experience. So I have my own trading service, and I'm a trader at asset management in Switzerland. And this is my homepage, tradingandpersonality.com. If you want to have more information, just check it, please. So this webinar series, Trading Spotlight. I'm partnering with Admiral Markets, which is a forex and CFD broker that offers trading on over 8,000 different financial instruments through one of the world's best trading platforms, MetaTrader 5. And finally, if you watch this on YouTube, remember to like this video, then share with other traders, and subscribe so you will never miss an episode. And finally, I want to say thank you to my great host beyond the scenes. He opened this webinar and he's supporting me through this afternoon. Thanks to my host, Roman. Okay, guys, what is currency correlation? And by the way, please use the chance to talk to me. Type it in the chat box if you have some question about it. We can talk about everything. And quick reminder, you are important. This is your chance. So most of us, I guess, we trade forex, which means we trade the currency pairs. And if you want to be an effective trader, you need to understand that your entire portfolio sensitivity to market volatility is really important. This is an effective trader, or I would say an experienced trader. So your account is really sensitive, and we have a high volatility into the market, and we need to understand how this kind of currency correlation works. And this is particularly exactly when trading forex, because currencies are priced in pairs, not single pair, two pairs, and they're completely independent to the others. So once you are aware of these correlation and how they change, you can use them, control your over portfolio's exposure. Think it through, come a little bit down, and maybe Stop trading right now. Stop watching charts right now. Stop watching the market right now. Nothing happens. Take this 40 minutes to listen to me. The more you learn, the higher you can, the higher the learn effect for yourself. So try to focus. This is kind of what I do every day. I try to meditate around 20 minutes a day, or 5 minutes in the morning to prepare my trading day, and during the day 20 minutes still and silent meditation. Why? It's a need for me to focus. You know, we are surrounded a lot of noises, election USA, then coronavirus, then the ISIS attack in Vienna, then the ISIS attack in France, then a lot of problems over all the world. So much noise, they have a huge impact to our minds. And then, by the way, every people is talking to themselves by 65,000 words a day. The male, our female, lovely woman are talking the double of words every day. So noises from outside, noises from inside. There is no wonder that you are done in the evening with yourself. So now it's time. Come down, cut all your noises around you. Stop trading, just focus what I try to explain this afternoon. So, because this is really important if you trade forex, that you understand how that really works. So it's easy to say, oh, I trade euro USD, but how, by the way, how is this euro USD pair working, and where is the combination, the relationship to other ones? And of course, yes, that's why I love Roman, because if you see the chat box, my host posted a link where you can visit us in our Traders Yard community. We have more than 200 people around there. And Jens, Paul, and myself, we are supporting there. We encourage you there. We share our trading ideas that you can follow them. You can ask your question, whatever you want. Please use it. Use it really strongly so you can get an answer to all your questions and all things you drive you crazy in your mind. And of course, use the YouTube videos on YouTube channel about Modern Markets so you can follow us. Okay, let's go on. In our financial world, correlation is a statistical measure of how two securities move in relation to each other. And then we have the same in currency correlation that tells us whether two currency pairs move in the same, opposite, or totally random direction over some special period of time. So you can have a check if they run into the same direction, 5-minute time frame or an hourly time frame or in 4-hourly chart, of course, and you can set a different time frame, historical part. Maybe you can check it, how they worked together through the last 12 months, for example. So you can figure out how they correlate to each other. So when trading currencies, it's important to remember that since currencies are traded in pairs, that no single currency pair is ever totally isolated. They are always traded in pairs. You cannot trade euro. It's not possible. You cannot trade Japanese yen. You cannot trade Aussie dollar. You cannot trade British pounds. You always need a second currency on the other side. Euro, USD, British pound, Japanese yen, USD, Aussie dollar, New Zealand dollar, whatever. The universe is almost limitless, almost limitless. So unless you plan on trading just one pair at a time, it's crucial that you understand how different currency pairs move in relation to each other. Because if you trade Aussie, British pound, euro to USD, okay, on one side you have different currencies, on the other side just only USD. You have to understand how they work and how they move in relation to each other. So there's a very interesting point, and if you watch this video or if you watch it later on YouTube again, I guess on Friday you will find it in YouTube channel, I guess on Friday, then you can make a screenshot, for example, of this one, or you can make now screenshot right now, and you can see what does I try to explain. What do I try to explain? So correlation is computed into what is known as the correlation coefficient, which ranges between -1 and +1. Or maybe some tables you can find -100. So there's a number between 0 and -100. It's most of the times a red color. And on the other side, you will find +1. Or in some tables in the internet or online, you see +100. Most of the time, it's a green color. Yes, with the green color. So if you have a perfect positive correlation, which means you have a correlation coefficient of +1 or maybe +100, this implies that the two currency pairs will move in the same direction 100% of the time. And two currency pairs, that's more than one. One pair means Euro USD. So implies that two currency pairs, which means Euro USD, for example, and USD Swiss franc on the other side. Two currencies, one pair, two currency pairs. Please be aware of that. So, and on the other side, we have a perfect negative correlation, which means we have a coefficient of -1 or maybe -100 in some tables. That means that the two currency pairs will move in the opposite direction 100% of the time. So this is the so-called coefficient. Either you have +100 or any number in between, or -100, -1, or everything in between. So you can see it in the slide on the left side in this picture. So red means from weak, 0, 0.5, 1 minus. Red means it's a weak correlation, then a medium correlation, and -1 means you have a strong correlation coefficient, which means red minus. Negative correlation means the two currency pairs moves in the opposite direction. It's a kind of diversification by the word, of course. Or +1, so maybe you see you have weak 0.5 and 1 +1, 1.0. That means it grows or increases from weak to strong. The higher the number, the more or the stronger the correlation from two currency pairs. So maybe Euro USD and maybe Aussie USD, for example. Same direction. The higher the number, the more they work, they move in the same direction. So, and maybe you come up with your thoughts a little bit. And you can think it through how you can make a little bit more money in the market. This is the deeper sense of correlation. So the reason for the interdependence, of currency pairs is relatively easy to see. If you're trading the British pounds against the Japanese yen, in the bracket you can see British pound / Japanese yen pair, for example, you actually trade a derivative of the British pound dollar and dollar Japanese yen. So you have to be aware of all those currency pairs. So British pound Japanese yen must be anyhow somewhat correlated to one, if not both, of these other currency pairs, because on the one side. For example, good to know, I would say it's the key factor. The dollar is the leading currency around the world. Why? I don't know. It was in a previous time, in a long, long time ago, some people decided the dollar must be the leading currency around the world. So you see, most of the times in currency, you have the dollar in a pair. Euro dollar, Japanese dollar, British pound dollar, Aussie dollar, New Zealand dollar, blah, blah, blah. Always dollar in it. So, but if you trade British pound, Japanese yen, which is absolutely possible, you have to be aware that you need to have a look at British pound to dollar and dollar Japanese yen, because the dollar is always the leading currency in the world. And they must correlate it to each other, either to one British pound Japanese yen, to British pound USD, or to both of them. Anyway, anyhow, somehow, somewhat. However, the interdependence among currencies stems from more than the simple fact that they are in pairs. It's not. Let me explain this a little bit more carefully. Guys, if you want to be successful in trading, it's not enough to push the button to go long and short. It is not enough. If it were enough, then everybody could be a trader. If it were enough to go long or short, everybody were rich, you know? But it isn't. See the bottom of this slide. 81% of all retail investors are losing money. Now, today I got an email from a lovely guy. He wrote me such a huge text, and he said, and he wrote to me an email. He's confused. He almost lost his completely full self-confidence and self-esteem. So why? He's a huge boss of a huge company, and he know how to lead people. He know how to make money with his company. And since 5 years, he tried to become successful in trading, and he lost almost everything: money, self-esteem, self-confidence, everything. And now he wrote me and said, help me, please. I don't know what to do. Yeah, that's the problem. So it's not enough to know how you go long or short. If you work in forex, if you work in shares, if you work in stocks, in futures, in options, whatever, you need to know how the market is working from the basement, from the basics. You need to start with the first steps, then grow up, then processing, forward and forward. It's not enough if you think you can open an account and push the button for long or short. It is not possible to make money in that way. So this is more than the simple fact to trade a pair, to say, oh, I trade Euro USD. Yeah, you can, of course. But if you want to make money in the market on a long term, not just only in a short term, this is by an accident. That's possible always. But if you cannot repeat your success, you cannot be successful, and you cannot become a successful trader who care for your family. You can pay for the bills and rent and something else. And I guess this is the point where you come to trading, because you want to make money, not just only today or tomorrow, 1 month. I guess you want to care for your family, or maybe you want to care at least for yourself. Or you may, I guess you want to save money for whatever, kiddies, or your retirement, or vacation, or shoes for your girlfriend, or whatever. And for that, it's unfortunately not enough to know how you push the button, go long, short in Euro USD. And I hope you will follow Jens, Paul, and myself in all our education webinars and trading spotlights. And we work on different things to surprise you. Yesterday, we had a lovely meeting with Admiral Markets. We shared a lot of ideas how we can make you better and better, and how we can guide you better that you can become a successful trader, except of this education webinar. So please be excited. We work on it. Coming soon, we used to say, coming soon. Okay, while some currency pairs will move in tandem, other currency pairs may move in opposite directions, which is, in a sense, the result of more complex forces. You see, it's complex. As I said, it's not enough to push the button for long and short, to think you can go long in Euro USD. Yes, you can, but without deeper knowledge, without a proper education, it's not possible to make money in the long run. So it's important to note that in forex market, currencies are not traded in kind of isolation. They are traded always in pairs, that I try to explain. So each pair's valuation is based on a constantly changing exchange rates between two currencies included in the pair. So if you trade Euro USD and you want to buy Euro, someone needs to sell dollar. And if you want to buy dollar, you need someone on the other side of the book map. He wants to sell Euro. So it's different to maybe if you trade futures, or if you trade a share like Apple. So Apple has one order book. So, and either you can buy Apple, you can sell Apple share. And if you want to buy, or if you want to go long in an Apple share, then you need on the other side of the bookmap someone who wants to sell the share of Apple. And if you want to sell your Apple share of your accounts, then you need someone on the other side of the bookmap who wants to buy Apple. And I guess the sure, or the more sure you are that you are right with your buying or with the selling, the other side on the bookmap is also sure he's doing the right thing by selling or buying. So welcome to the trading market, of course. But there's a difference. Or if you trade futures, DAX, S&P 500, Dow Jones, or something else. So there's one thing you can sell or buy one contract of Dow Jones. If you want to buy a contract of Dow Jones, you need someone who wants to sell. But in forex market, that's different. If you want to go long in Euro, that means you want to buy Euros, but it's a pair. It's Euro USD. So if you want to buy Euro, because you want to go long in Euro USD, which means you want to buy Euro, that means you need to sell, you need someone on the other side who wants to sell the dollar price. And if you want to go short, which means you want to sell the Euro, you need someone on the other side who wants to buy the dollar price. This is different. We have two. While you have in shares and futures and options, one part, one contract of anything else, in Forex, you have two single things: Euro, dollar, dollar, Japanese yen, British pound, New Zealand dollar. If you want to go long and chip in British pound, New Zealand dollar, you want to buy British pound, sterling, then you need another one who wants to sell New Zealand dollar. And now we think it through. We have the Bank of England and we have the Bank of New Zealand. Different politics and policies, of course. Different directions, different rates, something else. It's not easy. It's not the simple thing to push the button for go long and short. You need, what do you do in Forex trading? And it's a common, it's a common practice for Forex traders, or maybe investors, swing traders, to be actively trading multiple currency pairs at the same time simultaneously. If this is the trading strategy, which is one of mine, then the trader or investor must be aware of the correlations concerning each currency pair that is being traded. And this is what investors are doing. And if you want to become a successful trader on the long run, of course, you have to be aware that you traded 4 currencies. If you make currency trading, currency correlation, then you have to be aware of 4 different currencies. Maybe you want to make a correlation trade in Euro USD and in US dollar Swiss franc. So, might the force be with you, of course. So you have, Jesus Christ. So you have, just a different one. So you have to be aware of euro, dollar, Swiss franc, and of course dollar again. Euro USD, US dollar, Swiss franc. 3 different currencies. You see, it's not that easy as you think, or as you thought maybe you can do in trading forex. So without a functioning currency correlation defining the degree of the relationship between traded pairs, it's very likely that a trader could unintentionally increase risk when attempting to diversify the portfolio. So you need to know what you have to do in forex trading. And if you realized a little bit that you have plus 100 and minus 100, there must be existing a higher chance to make money. If you know that you have different currency pairs, they move in opposite directions, and you go long in this one, you go short in this one, you can make money on both sides if you have a correlation of plus 100, a really strong correlation coefficient or efficient. Okay, think it through. But you need to be careful if you have your 2 different pairs, they're moving in the same direction. You have a cluster risk. Be careful about that. One of the most important aspects to remember regarding currency correlation is that they are constantly changing in value. What does it mean? Take an USD, US dollar. Sometimes it's more, it has more value, then on the other side it has less. We can, it was an interesting thing about the stimulus package. So when there was the rumor in the market, they want to have they want to confirm this $2 trillion stimulus package, the dollar getting weaker, because if they pump so much money in the market from the US dollar, it must weakening the dollar. But the moment they were disagree about this stimulus package, the dollar increased, getting stronger. So you see, every day, every week, we have a changing in the value of every single pair. And as exchange rates of the currency pairs themselves fluctuate, the relations between their pairs involve, of course. The correlation of a currency pair today is not necessarily the correlation of the currency pair tomorrow. Again, the last sentence, think it through. Maybe you get it by yourself. The correlation of a currency pair today is not necessarily the correlation of the currency pair tomorrow. What do you think? In which time frame we're talking about? What do you think? Where is relation? It's a test if you follow my words, guys. In which time frame could it be happen that a correlation of a currency pair today is not necessarily correlation of currency pair tomorrow. Is it possible in 5 minutes, or is it more possible in 5 minutes than in 4-hourly chart, or is it more possible in 4-hourly chart than in 5-minute chart? What do you think? Think it through. It's not that complicated. Okay, I tell you, I guess it is complicated. So, of course, the lower the time frame, the more often you have a changing. If you have the correlation in 4-hourly charts and daily charts, it's not interesting of 1 day. So the higher the time frame, the less changing you have in the correlation. The lower you on a time frame, the more you have the changing of the currency correlation, because every day the value is moving. But if you're trading 4-hourly chart or maybe in daily chart, you have less moving and less changing in the single value of one single currency, of course. Okay. How we can use currency correlation? First, they can help you avoid entering two positions that cancel each other out. For instance, by knowing that Euro USD and USD Swiss franc move in opposite directions nearly 100% of the time, you would see that having a portfolio of long Euro USD and long USD Swiss franc is the same as having no position. Because as the correlation indicates, when the Euro USD rallies, USD Swiss franc will undergo as a sell-off. Okay, let's have a look at the chart so you can see just a quick chart, because we want to go later to the example. So this is Euro USD, and on the right side you can see USD Swiss franc. So what do you basically see? Okay, you can see Euro USD. You have a stronger Euro and a weaker USD. And on the other side, you have, of course, you have a weaker USD. That's the same like in weaker in Euro USD. And you have a stronger Swiss franc. So, and now think about it. If you would go long in both of them, you see, it makes no sense. Because if you are long in Euro USD, for example, then you make profit. But if you are long, maybe in USD Swiss franc, you will lose, because your USD Swiss franc is decreasing while Euro USD is increasing. So you see, if you have a coefficient of 100% and of a correlation, a negative correlation between two currency pairs, it makes no sense to go long in both of them. It makes no sense. If you have a negative correlation by 100%, you have to go long in the other side on one currency pair and to go short on the other one. It makes no sense. Otherwise, you have zero, no profit, because on the one side you make profit, on the other side you make loss. Makes no sense. You see, it is this kind why it makes no sense to go long if you have a negative correlation. Or switch to the slide again. On the other hand, holding Euro USD and long Euro Aussie USD or New Zealand USD, then it's similar to doubling up on the same position, since the correlations are so strong. Because you trade, the second pair is always USD. And if you have a weaker USD, most of the time USD is weaker against almost every other currency. So if you trade short, or maybe if you trade against the dollar, if you are speculating on a weaker US dollar, You will go long in euro, and you will go long in Aussie, and you will go long in New Zealand USD. Because on all these currency pairs, the second part is USD, which you have a weaker USD. All the other currencies are increasing while USD is decreasing and getting weaker. So, guys, just a quick question. Did you understand it? Do you get it, what I try to explain? Give me a yes or give me a no, please. Just a couple of words. Give me a hint if I am wrong or is it too complicated? I really try hard to explain it really easily. So please give me a yes or give me a no. We have almost a lot of listeners this afternoon around the world. Thanks for joining. Give me a yes, please. Give me a yes or give me a no if you don't understand and what you don't understand. So I have yes, yes, yes. Okay, not really, Paul. Okay, maybe you can give me an example. What you don't understand? So, but most of us, you understand. So maybe Paul, please. Oh, there's another question. I can see it. Other currency increase while dollar decreases. Am I right? Yeah, most of the times. Most of the time. Not always and not in the same strength. So which means you have a weaker dollar, for example. It means basically that euro is getting up, Aussie dollar is getting up, and New Zealand dollar is getting up. Or maybe Japanese yen is getting up, but not in the same strength. Maybe the euro is getting higher, the US dollar is getting not so high, but a little bit increasing, and New Zealand dollar or British pound, same. But basically, if you have a weaker dollar, the dollar is weak against every other currency, but not in the same strength. But basically, you're right. Fine. So here we go. Diversification. Oh, there's Paul. Here we go. Does it mean that anytime order currencies are increased, dollar is decreasing? It depends, Paul. It depends which currency do you trade. If you trade British pound against Japanese yen, it's not the dollar in it. So, but if you trade Japanese yen, US dollar, then you have to be aware what's about the US dollar. And of course, not any time. That would suppose we had a 100% strategy. Doesn't matter, of course not. But basically, you are right. But not any time, and not in every currency. But if you have basically a weaker dollar, it is weaker against almost every other currency like euro, Aussie, New Zealand dollar, something else. But that's we have a big advantage, Paul. We have our trading spotlight community. Watch the chart. Watch the chat. My host put the Traders Yard group already in the chat box. So just only one requirement: please open a trading account at Edmund Markets. Put some less deposit on it, and then you have access to our trading community. Then we can talk about everything by video chat, of course, if you want, by texting, or you can type an email, whatever, text an email if you want. So I want that to become successful, okay? So let's talk about diversification last minute. Since the Euro USD and Aussie USD correlation is traditionally not 100% positive, traders can use these two pairs to diversify the risk somewhat while still maintaining a core directional view. So if you have a weaker dollar, maybe you have increasing euro and increasing Aussie dollar, but not in 100% of all cases, of course not. Let's take an example to express a bearish outlook on the USD. The trader, instead of buying 2 lots of Euro USD, maybe it could be interesting and a good thing to buy 1 lot on Euro USD and 1 lot long on Aussie USD. This is how you can diversify your accounts. So, of course, by the way, based on a simple and repeatable, constantly strategy, rules. Look at this one. Stick to the rules, because we have not that impact and we have not that money that we can influence the market. And by that reason, we only have to work with probabilities, which means we have to understand the functionality of the market, and we have to work with a strategy which is proven, statistically proven positive, of course, and we have to follow the rules like a trading plan. And I ask again, do you have a trading plan? Do you have a strategy? Do you have a business plan? If not, I promise you, and this is a guarantee, you will never become successful in trading on the long run. That's a fact. It's a promise and it's a fact, of course. The imperfect correlation between the two different currency pairs allows for more diversification, marginally lower risk, of course. So divided one lot, this one lot, this one, instead of two lots in one currency pairs. And of course, furthermore, the central banks of Australia and Europe have different monetary policy biases. So in the event of a dollar rally, the Australian dollar may be less affected than the euro, or vice versa, whatever. So therefore, you should make this kind of diversification. But basically, always you need rules on both sides. You cannot go blind into the market. Oh, I want to go long there, and okay, I go long there too. That's stupid. Rules on both sides. Maybe trend trading, for example. Okay. Regardless of whether you are looking to diversify your positions or find alternate pairs to leverage your view, it's very important to be aware of the correlation between various currency pairs and their shifting trends. And this is powerful knowledge for all professional traders holding more than one currency pair in their trading accounts. And believe me, it's possible with a less deposit in your account. If you have $100 in your account, it's possible. Because with this lovely broker at markets, you can work with a micro lot. So you can do that even in 4-hourly charts. Okay, you cannot make money, that huge money, but you can increase your money from a small account to a huge account during the time, and sticking to the rules and working with this deeper knowledge. Because this knowledge helps traders diversify, hedge, or double up your accounts. So now, last 2 minutes, let's go to the example. So let's see. You see on the left side, for example, we have Euro USD. On the right side, we have US dollar Swiss franc. That's, you can see, we have oh, where is it? Just a moment. I wanted to open the on MetaTrader 5, you find in the bottom view, navigator, you see on the lower side, you see correlation matrix. Here we go. That's the correlation matrix, for example, and you can open it. So here we go. So here we go. And it takes a little bit of time. So here we go. You see, that's the tablet of the correlation matrix in MetaTrader 5, of course. So now you see left side, first currency, right side, euro, upper side, second currency. So now just only have a look at almost 100%. So here we go. For example, Euro USD and Aussie USD plus 91, which means plus is a positive correlation, which means both of them, most of the times, moving in the same direction. It's a kind of cluster risk because both of them are working upside or working downside. So if you make profit, you make profit on both sides. So, but if both are weak, you lose on both sides. So I can share my experience. I just only work in negative correlations. It's the better thing. So just have a look at minus. Minus means, look at this one. For example, USD Swiss franc and Euro USD minus 99. So which means that's an almost perfect negative correlation. They most of the times, and I set 4-hourly charts with 1,000 candles, it means most of the times they move in the opposite direction. So if you go long in USD, you have to go short in USD Swiss franc based on rules, of course, guys. Don't forget that. So now you see the chart on the left side. For example, let's do it in that way. So we have, maybe do see this, just quick this one. So movement, correction, movement, correction, movement, correction, movement. So first chance to go long anywhere there roundabout, maybe in a smaller trend size. Second chance, here we go. And on the other side, you have exactly the same, but it's short, moving, correction, moving, correction, moving, correction, moving. So first chance to go short, it's round about here. Second chance, round about here. Third chance, round about here. Like third chance, here is there. So you see, that's absolutely fine. So you have the chance to go long there and short there. So you have to go along there and there. Okay, got that. Okay, third time there and short there. So, and this is a perfect example for correlation, currency correlation. And I use them in the asset management with huge money. And I use those things in, for example, in on my private account. So let's, I guess we are done. I guess you see the sense of how you can work on it. So my suggestion for you is just have a look at negative correlations. And the higher the correlation, the stronger and the more you can make money on both sides. So let's make a short conclusion. To be an effective trader and understand your exposure, it's important to understand how different currency pairs move in relation to each other. I hope you understand it right now. And some currency pairs move in tandem with each other, while others may be polar opposite. And learning about correlation, currency correlation, helps traders manage their portfolios more appropriately. And of course, please, regardless of your trading strategy and whether you are looking to diversify your positions or find alternate pairs to leverage your view, it's very important to keep in mind the correlation between various currency pairs and their shifting trends. And let me finish this based on rules on both sides, always. This is the most important part. So let me invite you to a Traders Yard group. We are more than 200 guys in it right now. And what is your suggestion for a beginner in forex trading? You want to know? Please take a mentor. Take your money, spend it your education, invest it your education in a coach or mentor or a teacher. Stop trying it by yourself by try and error in the market. This is my suggestion for you, especially as a beginner. Compare with a normal job. It's not enough to watch a video to be a surgeon, to be a pilot. It's not enough. Even for a craftsman, it's not enough. You need a teacher. You always have a teacher. And guys, trading is a job. It's a business. It's a serious business. And one of the reasons why 81% lose money is they think they can do it easily, but it doesn't happen. So this is my suggestion for you as a forex trader, whatever kind of trading. So, and of course, open an account at Admiral Markets, put some deposit in it, and follow our advices. Maybe this could be a great thing. So next Friday, my lovely continuous partner Jens is talking, how does a broker make money? Oh my God. I guess we should know that on Friday, 6th of November. And then guys, I want to say thank you. Brain not possible to do a tasking. Brain not possible to do tasking. Okay, I don't know what you mean. I want to say thank you for your time. Oh, a little bit up to the time. Now I wish you all the best for this day. I wish you stay on the sideline. We have trouble around the world. The election, and tomorrow we have rate decisions, British pound and Fed. So stay on the sideline and please learn trading with a mentor, with a coach, at least at Admiral Markets with the Trading Spotlight community. So I want to say thank you. You can contact us whatever you want. And thanks for your lifetime. I hope you learned a little bit for your own trading. And I wish you all the best. Stay healthy. Take care for you and yourself, and for yourself and your family, of course, your friends. And then we will hope we will see each other next Wednesday with the next topic about commodity trading. I say thank you. Have a nice time. And always be careful about your thoughts. They're the beginning of your actions. See you. Bye-bye.